Welcome to this tutorial on financial modeling using Kaluta projection methodology. We have thus far made business valuation using intrinsic value approach. That is, valuing the business using discounted cash flow methodology. Normally, other measurements are used with a view to having different perspectives in valuing the financial health of the business. And for this matter, rational analysis is one of the major area of valuation metrics that are used for that matter. So in this exercise, we are going to do ratio analysis, but usually the intrinsic value approach and specifically net present value approach is the best methodology to use for valuation, and it is the one that is used for decision making as far as business valuation is concerned. Now let us go to profitability ratio analysis. So ratio analysis is the quantitative measurement of relationships between line items within the financial statements with a view to gauging the financial health of the business. So basically there are areas under which ratio analysis is used with a view to gauging the financial health of the business. We have profitability ratios, liquidity ratios, efficiency ratios, solvency ratios, and shareholder investment ratios. These are the major classification of ratios that are used for the purpose of valuing the business. So we will start with profitability ratios in this tutorial, and we will do other areas in other tutorials. So we are going to do this on our projected financials on both monthly and on annual summaries. Okay, so basically profitability ratios are the ratios that analyze the financial health of the business and specifically the profitability health of the business to see if the business is profitable, okay, in relation to the resources that have been deployed to run the business. And there are two categories of ratio analysis in the profitability. There is margin analysis and return analysis. Margin analysis measures the ability of the business to turn sales into profit, while the return analysis measures the extent or the ability of the business to produce return for shareholders. Okay, so for the margin analysis we have gross margin, which is gross profit divided by net sales, and net sales in this case means sales that have already uh, taken, sales after deducting returns and discount. Okay, so those are the net sales. So gross margin is gross profit divided by sales, which is net sales. Profit margin, that is profit after tax, divided by sales, net sales of course. Operating profit margin, which is, this is the operating profit. That means you take sales, you minus direct sales, and you minus operating expenses, but before interest expenses and taxes. Okay, so that one is called earning before interest and tax. Okay, so that is operating operating profit margin. Okay, so that is for the margin. For the returns, we have return on assets, that is profit after tax divided by average total assets. Okay, now for the returns, in the margins, we have seen that all line items come from income statement, and income statement is a flow statement. That means the transactions that are captured within income statement are the transactions that occur during a period of time. So whether it is monthly or annually in our cases. Okay, so during a period. While the balance sheet is a stock statement, it captures the transaction as at a specific date. Okay, now for the gross margin, we only have transactions from income statement, while for return, we are actually comparing the transaction from income statement and balance sheet. Okay, now because the transactions from income statements are captured during a period, for example during a month or during a year, while the transactions at balance sheet are captured as at the end of that period. If it's a month, at the end of the month; if it's a year, at the end of the year. Then we need to take average for the line items that originate from balance sheet. We need to take the average starting and the end of that period, so that we can compare them with the line items in income statement. Okay, so for return on assets, we take profit after tax divided by average total assets. Return on equity, we take profit after tax divided by average equity. And return on capital employed, so profit after tax divided by capital employed, which is equity plus debt, long-term debt. So those are the ratios that we are now going to do computations for them. Okay, so we will start with our monthly financials. So here, let me clear this and go to our monthly workings here. For example, here in balance sheet, and then take this It is from year 1 up to year 3. So I'm going to copy all this. We will do our ratio analysis for monthly purpose. Let me start here. During year 0, this is the time when we haven't yet started generating sales for the business, okay? So this is an outlier period. We will not do ratio analysis during this period because we haven't yet started normal operations. So we will start our analysis of ratio analysis from the month of April, where the year 1 starts, okay? So that is what we will take. So from here, and I'm going to copy this up to the end of our projection period, which is the end of year 3. Here. And then I copy that. And then go to our ratio analysis sheet here. And then paste it there. Okay, so I need to first create some rows before I do that exercise. Let me create some rows. Insert rows. Yeah, that one is enough. And let me go back again there to balance sheet, and then copy this, and then come to ratio analysis here, and then paste this one here, paste this, okay? So we start with gross margin, okay? The gross margin, as we said, is gross profit divided by sales. So we try to look for each dollar of sales, how much gross profit has been generated, okay? So it measures the efficiency of turning sales into gross profit, okay? The higher the metric, the better, okay? That means you have higher capacity to turn your sales into gross profit. So in this case here, in April, we put the formula there, gross profit divided by sales. So I start with equal sign, and then the gross profit. Now we are in the month, so I go to income statement sheet on monthly basis here, and go to April, which is here, and then I'm taking my gross profit figure, which is here, gross profit divided by sales, which is this figure here. Press enter. So we have that, and then profit margin, this is profit after tax divided by sales. Again, start with equal sign, go to our P&L sheet on monthly basis, and then profit after tax is here, the figure is here, net profit after tax, which is here. In this case it is loss for this month, and then divide by sales figure, which is this one, sales, press enter. Okay, operating profit margin, that is earning before interest and tax, So I start with equal sign, go to our monthly earning before interest and tax. We are going to get now. So let me start with open the bracket and then take profit before tax, this figure for April, and then add interest component, which is the total finance cost here. Now we have earning before interest and tax, so I can close the bracket, and then this figure we divide it by sales figure. Press enter, and then okay, so the same profit margin, the shows how much of the sales is converted into profit. Operating profit margin the same. How much of the sales is converted into operating profit. That means for each dollar of sales, how much is retained as operating profit. So this is measuring the efficiency of producing profit within the business. ROA, return on assets, that is profit after tax, divided by average total assets. Okay, so that also measures for each asset that have been deployed within the business, how much is, for each dollar of asset deployed, how much are we generating return on it. Okay, so here start with equal sign, go to take profit after tax in the profit and loss sheet on monthly basis during April, which is here, profit after tax figure, and then divide by average assets, okay, total assets. So divide by, and then I type average and then open the bracket, and then go to monthly balance sheet. So we are in February, we are taking this in April, so let me go to monthly balance sheet, which is here, and so we can take total assets is this line in row 17, and because we are taking the April here, we will take the average figure for March and April, okay, because we are measuring the profit after tax figure is during the April. Okay, now if we want to measure total assets average, we want to take the average total asset at the beginning of the April, which is at the end of March and at the end of April. Okay, so we will take the average from here for March figure, total asset for March figure, and then let me, if I try to drag, I normally get the problem in doing that in using the tab, so I'm using the long way here of putting these okay, I put those full columns and then click on here to get that range, okay, to get the range of values that I need to, the summation of these values. from which I want to take the average. And then after that, I can close the bracket and then press enter. Okay, so I have my ROA computed, ROA. So again, we start with equal sign, profit after tax, here in the sheet, P&L sheet for April, profit after tax, which is here, divide by average equity. So divide by, start to type average, open the bracket, and then go to monthly balance sheet, and then total equity for the company, owner's equity is here. So average starts for this figure for March, owner's equity. Again, I use these full columns here, and then click on April, close the bracket, press enter, and return on capital employed. So here again, start with equal sign, profit after tax. I click on the P&L sheet, go to pick profit after tax figure, which is this one for April here. Okay, and then divide it by capital employed. So I open the bracket, the capital employed figure in this case now, because we are going to take two items. Okay, let me do it this way. So to make it okay, let us proceed first. So we are going to the balance sheet, monthly balance sheet here, and capital employed is, for this case, we are going to, okay, so it was average. So let me repeat it. Okay, let me repeat. First, to simplify the matter for our computation, let us establish equity plus debt figure in our balance sheet here. Okay, so I can put that figure here. Capital employed. Capital employed. So capital employed is going to be, start with equal sign, take owner's equity plus total debt. We have long-term debt here, okay, but we also have current portion of the long-term debt, which is classified in current liability, so we are going to add it there. So plus this short-term loans, it's called short-term loans. This is the current portion of long-term loan. Okay, so it's also part of long-term loan, so I add this one. Okay, press enter. So that is our capital employed, which has taken owner's equity plus long-term liability, okay, that is long-term loans, plus the current portion of long-term loan, that is short-term loans. So I can tap to fill this throughout our projection period. Okay. Right, so now we can go back and do our, in the ratio analysis sheet here. So our return on capital employed is equal to, so we are starting with equal to profit after tax. Go to P&L sheet in April here, profit after tax figure is this one, and then divide by capital employed, which should be the average figure also, okay? Average capital employed. So we start with average as usual, average, and then open the bracket, and then now we go to our monthly balance sheet. Then we can pick the figure for March here, and then as usual go to put the full columns, and then click on figure for April, and then close the bracket, press enter. Okay, so we have our ratios. Let me put it. The margin ratios, let us turn them into all of these. We put them into percentage terms. So I go here, put them under percentage terms. Okay. Now I can simply select these ratios here, and then copy, and then, or instead of using the copy, let me use the fill. Okay, so just select these and then fill throughout our projection period. So this is the monthly ratio analysis, and for our case, if you are doing modeling for overdraft, as I said, modeling for overdraft, you need to present your projected financials on monthly basis. Okay, you cannot put annual financials when you seek for overdraft facility. It should be on monthly basis. Okay, and for that matter, the ratio analysis for monthly will help now the banker to evaluate your projected financials for the purpose of seeking overdraft facility. But also when you do the business plan, normally the first year is the budget period, so it is projected on monthly basis. So still the ratio analysis for that is applicable. In my modeling, in my methodology, we have a period that is called pre-operating period. That is the period where you have not yet started operations, because you have not yet started generating revenues. Okay, so for that period there is no need to do rational analysis because it is not yet operational. The business is not yet operational, so the ratios won't have any meaningful interpretations out of them. Okay, so that's why we have started from year 1 here, that is during the operating period, the first month of operating period. So this is what I wanted you to understand, that, you know, as I told you, when people are asked to present financials for overdraft, seeking for overdraft, they will only present projected cash flow statement without being supported with projected income statement and projected balance sheet. That is as good as not doing anything about projected financials, because you cannot project cash flow in isolation of other financial statements. That projection is becoming inaccurate. Okay, so but this is the standard for even the bankers themselves. They are allowing people to present projected financials only on cash flow projection while they are seeking overdraft. That is wrong. That is wrong, because you need to if you are evaluating on monthly basis to see how the swing of the account as related to the overdraft that you are giving, then you definitely need to see both, not only cash, projected cash flow, but you also need to see projected income statement and projected balance sheet, because the cash flow, what is going into the cash flow is coming from the income statement. Okay, so you cannot, and what is actually what is going into the cash flow is coming from the income statement, but also the balance sheet shows the payables, receivables, those items that have not featured into cash flow statement because they are in accrual method. So you need to see all of them at once. So this is the advantage now of my methodology, because it will give you an in-depth insight into financial modeling when you do it on monthly basis. Okay, so we are done with our ratio for monthly, and the interpretation of these ratios I have already explained. Okay, but you now need to be careful, because these ratios are on monthly basis. If you have a business that is seasonal, then you cannot compare the ratios in the month of April with the ratios in July. It depends now on the cash flow pattern, the normal pattern of the business. Okay, so for example, if you are doing retail business for apparel, for example, in most cases during the end of the year you have more sales there compared to other period because of the holidays. Okay, so people are buying more of new apparel. Okay, so the ratios for December in that case cannot be compared for the ratio in January. Okay, so that is the monthly precaution when you evaluate the ratios. Okay, you need to look at the seasonalities. Okay, so of course for these negative numbers ratios is because we have losses in these months. Okay, and as you can see, these are just the months when the business has started to be modeled. So we have not yet started generating profit, and profit started to be generated here in July. There is where we have now our positive ratios. Okay, and in this case, if we look this ratio, for example, profit after tax of average equity, for the first month of April, it's too huge, because if we go to our average equity, because the profit that has been generated, there is a lot of leverage during this period of, because we have taken the loan, we've just taken the loan, the loan figure is huge, okay, to operate the business. So there is a lot of leverage. That's why there is this big figure for okay. Now let me check it out and explain it better. For example, we have taken profit after tax divided by average equity. So if we go to a monthly basis, the profit after tax figure here for April is here, which is negative. And then average equity, if we go now to monthly balance sheet here, and our owner's equity, which was the average between these two figures, and because this one is, you see, this one is a negative figure, so the total average ends up to be negative. That's why we ended up having a positive ratio, because the numerator and denominator for the ratio were both negative. That's why we ended up having a positive ratio for that matter. And definitely here we see the loan amount, 12 million loan figure, while the capital was injected for this was 10 million, but it has also already been the capital was eaten up by retained losses. Okay, so we are comparing, so the business is largely supported by loan instead of equity, because the equity is already eaten up. That's why we have bigger leverage there in our ratio. Okay, so let me go back here. Let me go back in ratio analysis here sheet. So we have seen those reasons, and I've already explained for other things. So after doing that, now we can do our, this was for monthly, we can do for the same for our annual. So I'm just coming here now and put, so let me go in annual sheet here. Annual sheet, annual profit and loss. Copy these here, 1, 2, and 3. So I copy that and go to our ratio analysis sheet and paste them there. So we are doing the same now, but in this case is for annual instead of monthly. So okay, let me come here and then view, and then freeze pens here, freeze pens, so that when I scroll, I still could see my column A and B line items. Okay, so I put my year. Where did I put? Okay, so I think I need to unfreeze pane first. Let me unfreeze pane. I have done the freezing on the wrong place because I don't see my this one. So let me repeat it again. So this one should be done now here. Freezing of the pen. Freeze pen here so that I can see my yes. Okay, so here the same gross profit divided by sales, but this time we are doing it on annual basis. So I start with equal sign, go to annual profit and loss sheet, and take gross profit sheet for year one, this one, divide by sales figure. Okay, press enter, and then profit margin, profit after tax, divided by sales. Again, annual P&L sheet, profit after tax for year one, which is here, profit after tax, divide by sales figure, which is here, press enter. Operating profit margin, start with equal sign, go to annual P&L sheet, and operating profit margin, that is ending before interest and tax. So we take our profit before tax for year one. Okay, let me start with sorry. Okay, let me repeat it again. Start with equal sign, open the bracket, go to our ending before interest and tax. Okay, so here we take profit before tax for year one, here, plus interest component, which is here, total finance cost, and then close the bracket, and then that one is divided by sales figure, which is this one. Press enter. Return on assets, so profit after tax divided by average total assets. So again I go to take this one, profit after tax, which is here, for year one, profit after tax, divide by average total assets. So I start typing average, this one, and then number one. So go to my balance sheet, annual balance sheet now, annual balance sheet, here in this sheet, annual balance sheet. Okay, so that is assets. We are dealing with total assets. Year one, average total assets, because we have in year zero here we still have figure for total assets, so we can take the figure for the beginning of year one for the purpose of computing the average. So we take total asset figure for year zero, and then that one, average, and then let me again use the same technique again, put full columns. Oh, that one is not that one. I have used a different approach now, so let me repeat it again. Let us use the same approach I used earlier. So profit after tax divided by average total assets. I start with equal sign, profit after tax for the year, annual, profit after tax, this figure, and then divide by average total assets, average, and then open the bracket, and then go to annual, balance sheet, here, total assets, total assets figure is here, so this one, and then press full columns here, and then click on year 1, then check. This formula is missing an opening and closing parenthesis. Okay, let me close the parenthesis here, press enter. Okay, so I'm done with the row part, profit after tax divided by average equity. So I start with equal sign, go to annual P&L sheet, profit after tax for year 1, here, profit after tax, divide by average equity. So I type average, then type, open the parentheses, average, and then click on annual balance sheet, annual balance sheet here, equity, owner's equity here. So average we take for here 0, and then put full columns here 1, so the average there. Then close the parenthesis, close the brackets, press enter. We have our rows, return on capital employed. So we need to establish our equity plus debt on annual profit and loss, on annual balance sheet here. So let us do the same as we did for monthly by typing capital employed, which is now taking owner's equity, this one, plus total long-term liability portion, plus current portion of long-term loan, which is this one, short-term loan. Press enter, and then tap to fill this throughout our projection period. Then let us go back now to our ratio analysis sheet here, and rows. So we start with equal sign and profit after tax. We pick it from our annual P&L sheet here for year 1, which is this one, profit after tax, and then divide by average capital employed, average, open the bracket, capital employed, which is in our annual balance sheet here, and we take it the average for this year 0 and full colors, and then year 1. Then close the bracket, press enter. So after doing that, now the same, we are putting all these in percentage terms. Oh, sorry, what have I done? Okay, so I'm selecting all these, put them in percentage terms. Okay, I need to be home here, and then click on this one, percentage terms, and then I can now fill this throughout up to year 3 here. So we have our ratio analysis for projected annual financials starting from year 1, leaving year 0, for the same reason that this is the period when we haven't yet started normal operations. That means we haven't yet started making sales. So we have taken it for year 1 and year 3. And because these ratios are on annual basis, then they have already averaged out the monthly fluctuations. Okay, so these ones are making more sense. But yet, if you are doing the budgeting, you need to project on monthly basis, so your ratio should also be on monthly basis. Okay, so they still make sense for that, because that's what you can do. You cannot do ratio analysis on a budget that is presented on monthly basis and then you do ratio analysis for annual. That will not make sense. Okay, the same when you apply for overdraft facility, you need to have your projected ratio on monthly basis, because your cash flow statement, your financial statement presented for the purpose of seeking overdraft are presented on monthly basis. So that's all for this presentation on ratio analysis, and specifically ratios on profitability analysis. Okay, so we have our financial metrics that compares one line item against the other in financial statements. Okay, so these are the ratio analysis. Okay, so let us end up here for this presentation. Subscribe to my channel if you find it useful. It will help me for promoting my tutorial, so that others can also access the tutorial, and that one will give me strength to continue with this. There are a lot of things I need to do, and especially we are almost at the end of our tutorial, and after finishing some of the tutorials, I will start presenting now the templates for different business model for different industries. Okay, so if you have gone through all these presentations with me from beginning, then you could easily follow up on those templates, because I'm not going to use much of my time explaining on the templates. I will simply explain the formula that were used, just to give a synopsis of what has actually been planned for that. And so, bye guys for now. Subscribe to my channel, as I said, as I asked you to do. And if you have any question, drop it down. I will be more than happy to answer it. Of course, as far as these presentations and my tutorials are concerned. And share it so that others are also becoming informed of these tutorials. Bye.